In 2014, the largest technology companies in the world spent about $44 billion a year on capital investments. By 2024, that number passed well over $200 billion. And almost all of the increase had one name attached to it. You guessed it, AI. This isn't incremental spending at all. This is not an innovation bucket. This is the largest concentrated investment of capital in corporate history. 7 companies, the so-called Magnificent Seven, are now spending more on AI infrastructure than the entire global energy sector. They're pouring money into chips, into data centers, custom silicon, heck, even nuclear plants. And this is before the business models are proven, before margins stabilize, and before regulators catch up. And here's the uncomfortable question no one likes to ask. What if it doesn't pay off? In this episode, we are going to follow the money. Not the hype, not the demos, the actual dollars. Where are they going? Why they're going where they're going? And what has to be true for this multi-trillion-dollar gambit to work? Because when capital moves this fast and this aggressively, it's not about optimism. It's about pressure. And pressure always reveals the real story. Welcome to the podcast. This is Ship AI, episode 2, Follow the Money. Let's go. All right, let's start by looking at the big bet. So let's start with this picture. So the US macro level data shows that the AI related investments have surged in the last few years. You can see the squiggly graph at the top. The investments, capital investments into the technology sector that's related to computers, communications, equipment, and semiconductors far outpaces anything else since 2020. There was a little blip, and then, of course, it took off. Whereas if you look at the energy sector, it's barely grown, whereas the rest of the non-energy, excluding telecoms, has remained largely flat. This is not a normal tech cycle. This is industrial scale reallocation of capital. AI is no longer riding on top of the economy anymore. It is the fastest growing sector inside it. I mean, some have argued it's a sector unto itself. When the production curves diverge like this, innovation stops being optional. It becomes structural. It is part of the cycle. This is the physical foundation that has made AI possible, all those models and data hungry planet scale models possible. Here's another graphic just to substantiate the previous point. Look at how the data centers are bucking the trend in private, non-residential structures. So in the 12 months ending on June 2025, data center construction has soared up 28% and up 331% from 2021. In stark comparison, the private sector spending on overall non-residential construction fell 4% over the course of the last 12 months. That should tell you that all the money that's being invested from all the capital investment, bulk of that investment is going into building these data centers. Let's go deeper. The Magnificent Seven that we talked about previously. Once again, that's the Amazon, Apple, Google, Meta, Microsoft, NVIDIA, Tesla. Their capital investment in the last few years is 63% year-on-year growth in 2024 alone. 15% of their revenues are going towards capital expenditure. This is infrastructure spending at a scale we have not seen since the mainframe era from IBM in 1969. Let's go deeper. This chart from JP Morgan clearly shows the divergence. The Magnificent Seven's CapEx plus R&D has grown 6, not 6%, not 60%, X since 2020. The rest of the large market cap essentially flat, as you can see from that squiggly yellow line. In fact, the Magnificent Seven capital investment now exceeds that of the entire energy sector. Again, this is complete corporate capital reallocation. So another way of interpreting this chart is AI progress is being decided by who can spend. That's the critical element. What these AI companies are now doing is they're building economic moat around the models. The progress is going to be decided by who can spend building the data center, acquiring the energy, acquiring the data, acquiring the GPUs to build the models, and not just about who can invent. Again, let's go even deeper. Let's put this in historical context. NVIDIA's data center revenues as a share of market wide capital spending are approaching 15%. That is at the same level where IBM's peak revenues were in 1969. That's the peak of the mainframe era, and the combination of Cisco, Lucent, Nortel peak revenues in 2000. So, the first chart on this page asks the question: is today's AI spending unprecedented? I mean, of course, the answer is yes. Now, AI's data center spending now represents a larger share of the total capital market than IBM at its peak, right? That we've already established. Now, let's look at where is the money being spent. As I said previously, across 2024, the total capex exceeded over $200 billion in a single year. What's interesting to note is half of that money goes directly to the GPUs and specialized chips. And here is the critical imbalance. Companies have to spend more than twice in training the models as compared to running them. So training of these models, these hyperscale planet scale models, this is a one-time cost. Inference is what scales with revenue. And for AI to become sustainable and profitable, this ratio has to flip. Here's another view of where the VC funding is happening, where the seed funding is going. So this is a chart from Y Combinator mapping out where all the startups are in AI in the dark blue or others. And you can see since the launch of ChatGPT in 2022, we are beginning to see a greater and greater concentration of investment in AI sector alone. Now, it's not just about the investments. There is also revenue velocity that these companies are seeing, by the way. And then I'll show you yet another view on some of the investments that are being made in form of a circular loop. But before we get there, let's look at the economy. The fastest revenue ramp in software history has been exhibited in the last 3 years by OpenAI and Anthropic. OpenAI grew as much as 65 times in a span of 3 years. They went from approximately $200 million in annual rate of revenue in 2023 to projected $13 billion by August of 2025. Anthropic grew by 80 times, going from $87 million in ARR to as much as $7 billion projected for 2025. In comparison, Salesforce took 10 plus years to reach a goal of $10 billion in ARR. AI companies are hitting that in about 36 months. So, we talked about investments. We certainly talked about the revenue velocity, but let's also understand how these companies are coming up with newer and newer ways of finding revenue. So, on your screen, what you see is two companies right now, OpenAI and NVIDIA. OpenAI hit $500 billion in valuation in October 2025. At this point, it became the world's most valuable company, surpassing SpaceX. Reportedly, they are now seeking $830 billion in their next round. The other big bubble that you see in green is NVIDIA, market cap of 4.5 trillion with a T as of January 2026. They briefly hit $5 trillion in October of 2025 when DeepSeek knocked $600 billion in a single day. We'll talk about DeepSeek separately. These two companies sit at the center of an intricate web where capital flows back and forth as revenue. And then I'll show you how. So let's begin. Here's step one. Microsoft takes a 27 to 30% stake in OpenAI because again every funding round keeps diluting their stake. So the total investment since 2019 that they've made is about $13.5 billion. Here is where the loop comes in. So the money that Microsoft invests into OpenAI uses 80% of its training and inferencing infrastructure is spent on Microsoft Azure cloud. So 80% of its compute is being spent on Microsoft Azure. What does that mean? So Microsoft spends billions, invests billions into OpenAI. It gets not only that revenue back as cloud revenue, but it also gains its investment increases as the OpenAI valuation increases. So the money once again goes in circles. Let's now talk about NVIDIA and the OpenAI loop. September of 2025, NVIDIA announces a $100 billion commitment to OpenAI. In return, OpenAI agrees that they're going to deploy 10 gigawatts worth of NVIDIA chips into their GPUs into their data centers. So again, the capital goes in, revenue comes out. So NVIDIA gets the return back as revenue. And of course, as the OpenAI evaluation increases, that 100 billion commitment increases same for. So same scenario happening here. In the next step, you see a tri-party agreement. So now comes Oracle into the mix. So now it's a three-party agreement between OpenAI, Oracle, and NVIDIA. So in January of 2025, Project Stargates gets announced at the White House. It is a $500 billion commitment over 4 years, largest AI project ever. Oracle then OpenAI rather, signs a $300 billion deal with Oracle for cloud infrastructure. Oracle then commits $40 billion on NVIDIA GPU for their Abilene, Texas data center. That's basically 400,000 NVIDIA GPUs for a 15-year lease. So the triangle then closes. Money flows to Oracle, money flows to OpenAI, flows to Oracle, back to NVIDIA. That's the third loop in there. Then AMD joins the game. So in October of 2025, AMD announces a deal with OpenAI. AMD offers warrants for 160 million shares, about 10% of partnership of AMD. And the strike price is 1 cent per share. In exchange, OpenAI commits to 6 gigawatts of AMD GPU deployment. Of course, the scenario here is that the models that OpenAI is building and will build, they need so many GPUs that NVIDIA alone may not be able to fulfill that demand. So therefore, they are divesting their business model. So they're going to another chip manufacturer, AMD in this scenario. Now, because of this investment and this commitment from OpenAI that they are going to buy 6 gigawatts worth of AMD GPU, AMD then expects $100 billion in revenue over 4 years from this deal. As soon as the date was announced, the AMD stock jumped 35%, adding $80 billion to the market cap. Even NVIDIA's competitor is now in the circular economy. Everyone's buying equity into their own customers. That's another loop. Now, not to be outdone, here comes Amazon and Google with Anthropic. Amazon and Google, they both decide to invest in Anthropic. So the idea is that even though Google is training their own Gemini, a series of AI models, they are hedging their bets. So Google now owns 14% of Anthropic as revealed in court filings. And then AWS also enters into a primary partner for Anthropic's primary cloud provider. Google then gave access to Anthropic to 1 million TPUs, which is tens of billions, undisclosed, but tens of billion dollars in revenue. So now in this scenario, we have two competitors, Google and Amazon potentially. They're both getting cloud business in return, right? And they are both investing in Anthropic. Anthropic in return is using services from both cloud providers. So they're both getting their money back in terms of the services being consumed. So they're getting the one layer of return on that. Plus, as the valuation of Anthropic increases, the return on their investment increases as well. So you can think of this as a pincer attack on OpenAI, but yet another form of circular funding. Next comes the startup ecosystem. So now you have NVIDIA investing into XAI, Mistral, Figure AI, and OpenAI then investing into smaller startups such as Harvey, Cursor, and Ambience. So what's the idea here? So NVIDIA's VC arm is everywhere. X.AI is up from a valuation of $2 billion in January of 2026 to as much as $230 billion of valuation. Mistral, they participated into a 1.7 billion euro funding round. Figure AI, 50 million seed. It's now valued at $39 billion. Each one of these startups in turn is going to buy NVIDIA chips. The OpenAI startup fund in turn, they have deployed $175 million across 37 plus companies such as Harvey as an example. And to be clear, OpenAI invested only $5 million in seed funding in 2022 in Harvey AI. It's now valued at $2 billion valuation. Anysphere, now known as Cursor, or known for Cursor, the product, they invested $8 million in a seed funding round. It's now worth $29 billion market cap. All of them are using OpenAI's APIs. So now you can think of this as a downstream investment. So all of these startups, they got funding from OpenAI. OpenAI's investment increases as the valuation of those companies increases. But OpenAI also gets money back from those companies as those companies are using APIs to build their business model. Let's talk about the final step. I jokingly call this the house of cards, but here is the full network with some concentration stats. Really, at the heart of it all is just 8 or 9 companies that control the entire AI ecosystem. 53%, and there is also some concentration risk, by the way. 53% of NVIDIA's data center revenue comes from just 3 mystery clients that they don't disclose. In fact, 2 of their customers are responsible for 39% of their quarterly revenue. If any one of them stumbles, the world's most valuable company is in trouble. There is certainly, we talked about the dependency on S&P 500 of the Magnificent Seven, because the Magnificent Seven, they have driven 42% of returns on 2025. The tech sector represented by Magnificent Seven, it represents 63% of total gains in S&P 500. So we can call this circular economy. Some people have gone as far as to say that there is a concentration risk, potentially the B word, the bubble. But there is certainly enough stressors here to give us a pause that there is something going on here beyond just the natural routes of monetizing their services. Okay, let's take a step back. So we talked about investments being made, new economies and new models that are investing. We talked about the revenue velocity. But are there any projections of how big is this market? How big could this market potentially be? So, not to be left behind, consulting firms such as, in this scenario, Morgan Stanley, they have come up with some pretty bold assertions of the total addressable market for generative AI. And really, when they talk about AI, predominantly what they're talking about is generative AI. So, Morgan Stanley's projection is as much as $4 trillion, which is about 15% of US GDP, as much as the entire German GDP. And they've broken it down into just over $1.3 trillion in software and IT, another 1.1 trillion in professional services, and then you see the further breakdown into things such as customer operations, R&D, supply chain, etc. And the key assumptions behind these projections are that enterprises can expect to get 15 as much as 20% in productivity gains, that almost 50% of the tasks that are done globally are augmentable through AI, and that enterprises are going to have enterprise-wide adoption in AI. I mean, that's where this is coming from. And to be clear, they're not that far off in at least the early productivity signals that most companies have achieved. So here is some examples from various research studies such as MIT, Harvard/BCG, some studies from Stanford, the coding assisted coding studies done by whether it is Microsoft, GitHub Copilot, PayPal, etc. Across the board, what we originally observed is that for AI assisted coding, some of these firms were reporting as much as 55% efficiency gains, productivity gains, that they could write code faster, write documentation faster. PayPal CEO is famously on record that their developers were 30% more productive. Now, by the way, caveat here that these are all early signals, right? We'll get into a lot more detail upon company claims versus academic studies. But this is what the promised land is, that with all those investments, with the new economic models that are emerging, and these early productivity signals, potentially there is enough revenue to be had. Potentially there is a promised land that these companies are going to be able to make some money. Alrighty. Okay. Now comes Act Two. So we talked about the models. Let's get into the machine behind this AI. Let's get a little bit more deeper. So let's have a look at NVIDIA's revenue chart. So NVIDIA had revenue of $57 billion in the quarter ending October of 2025 with a nearly 63% growth. This brings the company's revenue in the last 12 months to $187 billion. Again, a 65.2% year-on-year growth. This is fantastic. Like this continually shows how, um, when there is a gold rush, the company selling shovels and pickaxes is the one that's going to make the most money. Now let's look at how the big tech is monetizing AI. And I've just chosen these as some examples, but I hope that it drives the point home. Microsoft. So what most companies have come up with is either a seat-based licensing, some consumption APIs, or some consumer consumptions. And then you can see Microsoft Copilot starts with $30 per user per month. ChatGPT has some similar costs. There is alternative consumer subscriptions as well. And then there is varied pricing. These are just the standard pricing there. You can get pro license, pro pricing, or unlimited, etc. plans for $200 a month as well. Now that new models have come up. On the cloud side, there is the Azure OpenAI service or the Amazon Bedrock, Google Vertex API. These are all API token-based pricing. But really what's interesting is that as the models become more and more, well, they become more and more accurate or bigger and bigger, they are under constant market pressure of reduction in cost in the token pricing as well. So we'll examine that in a bit more detail. Beyond the CapEx, there is a VC ecosystem that has invested over $200 billion in the last 4 years in the various seed rounds, just in AI companies, right? And what's interesting here is that there is so much, I don't want to call it hype, but so much interest. Nobody wants to be left behind. But what's really interesting for all of these companies is that, of course, public market demands profitability. It's creating a funding cliff. There is a gap between private valuation and the public market signals. So there might be some potential corrections for at least some of the companies that's coming. But in this arms race, one thing is absolutely clear. Beyond the GPU monopoly, there are new silicon that is emerging that's going to reshape economics. So far, all funding roads, all revenue leads to NVIDIA. But what we're now beginning to see is like a race for custom silicon. So Google, in particular, they saw this very early on in 2011, 2012. They started working on Google TPUs for some type of workloads, such as the inferencing workloads. They can be highly performant compared to NVIDIA at a lower price. Amazon has come up with Trainium, which is 40% cost reduction. So does Microsoft and Meta. So we're beginning to see projections of as much as $200 billion of revenue in just custom silicon alone. There is some new economics emerging around deployment of AI on the edge, on cheaper hardware, on commodity infrastructure. And then contrast all of that with what's going on with the supply chain reality. So the reality today is that there was a point in time where there was a lead time of 55 weeks, 53 weeks to get a NVIDIA, to get somebody's hands on NVIDIA H100. What we're also beginning to see is emerging competition from some of the existing vendors like Intel with their Gaudi 3 and AMD, which is 40% cheaper. So we'll begin to see a lot more pressure on NVIDIA from these new entrants. If that's not enough, but have a look at what's happening to the data center build time. So this is an example from XAI Colossus, where they built a fully functional data center in 2024 in 122 days. This is this is a data center which is 750,000 square feet in size, which is approximately 418 homes in the US. The average half-built house duration is 122 days. And on their website, they proudly claim that they were told that it was going to take 24 months to build this. And they decided to take the project in their own hands, questioned everything, removed what was necessary, and they accomplished their goal in 4 months. The reason I highlight this is that speed is becoming a competitive advantage. These AI megaliths, they are questioning everything and they're removing any unnecessary step in the way. To keep this in perspective, this is a 200,000 NVIDIA GPU supercluster. It's really a supercomputer, right? From rack to training of Grok, it took them just 19 days with a total target power capacity of 2 gigawatts. This clearly sets a new standard for infrastructure deployment. So all of that money that you see that's being invested into building the data centers, that's how that money is being used. But I wish that the building of the data centers was linear. There is certainly challenges. What do data centers need? They need two big critical things. They need energy, well, apart from space. They need energy, and they need water. So let's just talk about the energy constraint for the time being. So what's going on is that the AI's appetite for power is reshaping the grid. So data centers have gone to be using as much as 1.5% of the global electricity, which is a 12% growth. So it's going faster, 4 times faster than the total electricity growth that we can build in the grid in the first place. Geographically, 45% of the data center electricity is consumed in the US, followed by China and then Europe. So what have the big tech starting to do? They're actually now trying to build their own nuclear power plants. Right? So Microsoft, Google, Amazon, and Meta, they have made significant announcements and certainly investments into building their nuclear power plants to take into account predictable pricing, grid independence, so that they're going to be able to have high energy density. Here is some more details on it. So Microsoft, as an example, famously, it's a $1.6 billion project. They've gotten $1 billion of a loan from Department of Energy. They're going to be building a 835 megawatt nuclear plant. Not to be left behind, Amazon, $20 billion investment into the Talon Susquehanna PPA project. And again, you get the idea, right? So so AI is no longer just about data. It's no longer just about GPU. It is now about a whole new risk factor, which is around nuclear regulatory rights, water tribunals, and the grid interconnection queues. Not talked about enough yet is the hidden cost of AI, which is water. 5 million gallons per day is what a large data center requires per day. By 2030, the projection is that they're going to require as much as 317 billion gallons of water per year globally. To put that in perspective, that's the water that's used by the state of Texas. So the new risk vectors when it comes to increasing AI and efficiency of AI, that's going to require dealing with water rights tribunals, location arbitrage, nuclear regulatory delays, in addition to all the other challenges that the Magnificent Seven are dealing with. Okay, let's take a step back. So we talked about revenue and business models. We talked about how they're spending the money. Maybe there is one other perspective that we should talk about, which is the hidden costs that perhaps are not quite that evident in the first place. Okay, let's just talk about the training versus inferencing economics, and I'll show you a bit more detailed chart to drive home this point. So in 2027, if I look at the capex split, 27 billion was spent in training versus $12 billion in inferencing, as I said previously, to X. And again, just to recap, for AI to profit, this ratio has to flip because training is a one-time investment. Inferencing scales up with revenue. But have a look at what's going on here. This should give you an interesting clue on what's happening with these models. So this is a chart from Epoch AI. On the x-axis is the publication date. On the y-axis is cost in dollar. And again, its y-axis is the log scale. So that should give you an idea of how, when we build these planet scale models, how much money is required to train these models. So what is estimated is the cost breakdown to develop key frontier models such as GPT-4 and Gemini Ultra, including R&D and staff costs. So this is not compute alone. So hardware cost approximately we can estimate is about 47 to maybe as high as 67%. R&D costs are quite substantial at about 29 to as much as 50%. And the remaining 2 to 6% goes towards energy consumption. So what does this tell you? What they tell you is that the largest training runs will cost more than $1 billion by 2027, which means that the frontier models of tomorrow that are being trained, they will be too expensive for most organizations except, you guessed it, the Magnificent Seven, the most well-funded organization. So all that money that's being invested, that economic moat that I talked about, the investments in data centers, they are being built so that these companies can continue to build the biggest, the best model that there is at planetary scale with all of humanity's data and all of humanity's hopefully knowledge, and build beyond transformer architecture models and build a financial moat that nobody else is going to be able to surpass. So that inference versus training cost, that's the first hidden cost. Mind you, there is also a second element to this hidden cost, which is the cost of the talent. To put it in perspective, for every dollar that's spent in the industry on NVIDIA chips, the companies are spending 80 cents on talent. Personally, I think it's maybe perhaps even higher. What's really interesting is the top talent in AI, the top researchers, they are now commanding what top developers used to command in the Silicon Valley at the height of comp development, .com type of booms, and so on and so forth. A typical entry level data scientist, somewhere between 100K to 500K. At the top firms, the best of the best ML engineers can command as much as 800K. Top AI researchers, in fact, in some cases, the AI researchers have been personally offered multi-million, multi-$100 million bonuses. These are the stars that are really shaping the industry. And then if you look at the burnout in the talent, that's happening pretty quickly as well, because talent as a percentage of burn rate, about 20% of the investment in FANG companies is being spent on the talent. And then you can see that there is certainly an ongoing crisis in trying to retain this talent. It is not unheard of that talent is being poached from one company to the other at astronomical prices and contracts. All right, there is two new taxes that are emerging. So the previous two were well understood and well known, but there is a new tax that potentially was not accounted for historically. So prior to GPT-3, the idea was scrape everything now, pay nothing. Essentially, now the model is being shifted. For example, in GPT, they will have to license everything because the consumers, the content creators, the regulators are now waking up. Regulation is now catching up. So rather than just scraping anything and everything and not paying nothing, they now have to license everything potentially and pay perpetually. Here's some examples. So Reddit entered into a $130 million a year deal with Google and OpenAI. And the idea here is that because it's human generated data, which is quite highly labeled, that data is highly valuable. And rather than Google and OpenAI just scrubbing it, they're now having to pay Reddit for that data. And the strategic implication here is that it's going to be number one cited source in AI models more than 3 times in Wikipedia. Similar things apply for other news sources that you see here, like News Corp, New York Times, and so on and so forth. So, really, the annual estimated cost for data that potentially these startups might have not thought about previously is going to be over $800 million a year. My point being that training on free internet data is over. New entrants cannot afford the high quality web. This actually works in the favor of the Magnificent Seven and the builder of these planetary scale models that have started early on, because they now have this incumbency moat that new startups cannot pay. So, this is a data tax that locks in the dominant players of the industry. Here comes the next potentially historically hidden cost that is now going to emerge and make it even harder for newcomers into this segment, which is as regulation catches up, the regulatory costs, at least for enterprises, in many cases, they exceed the hardware cost for enterprise AI deployments. So, again, just to put it in perspective, If you think about the European Union's AI Act implementation in total terms of R&D, in terms of humans, in terms of providing all the risk documents and disclosures to the regulators, you're looking at least about $5 to $10 million if you're lucky, potentially higher. For the patchwork of regulations from various US states, you're looking at somewhere between $2 to $5 million per state. If it happens to be a global company that's working in Europe, they have to comply to GDPR. That's another $3 to $7 million a year. Therefore, for an enterprise, the total compliance burden could be as high as an additional 25% on AI budgets. That's purely on compliance. Add to it the research that every organization has to do on safety, so that ensuring that the model is not leaking any PII data, the model is not providing any guidance that it should not provide, that it is not hallucinating, as an example, that it's not providing hateful information, and so on and so forth. And by the way, there is two elements to that cost. There is the budget spent on safety and alignment of the model. So this is in the model training phase itself. Reportedly, Anthropic is spending as much as 30% of the budget on model safety and alignment, followed closely by OpenAI at 25%, DeepMind from Google at 20%. So that's $15 billion a year purely at the model training level itself. And then there is a second level of safety research investment that enterprises have to do when they're adopting this within the enterprise. The flip side of this is what these companies are now able to do is they are now approaching what they're calling proactive compliance ROI, which is that, hey, our models out of the box already are compliant to certain type of regulations, or we provide you these type of guardrails. Therefore, we can help you achieve the compliance quickly. And then there is some stats here in terms of how they can achieve proactive compliance. The point here being that it's both a cost, it's a hidden cost to some extent, but they're now trying to turn it into comparative differentiation by saying that compliance is no longer just a regulatory overhead, but if they were to build this compliance into the and safety into the model itself, they can use that as a competitive moat. All right. So we covered a lot. Let's now talk about let's now talk about the crisis within the business models. Let's spend a little bit of time understanding the margin crisis. So as the world moves away from the traditional SaaS, which was 82%, 80 to 90% of gross margin, to I'm going to call them, for lack of a better term, AI supernovas, which are venture capital subsidized. They only have about 25% gross margin. Because what's happening now? What's happening now is that as historically the SaaS companies, they would sell access to a tool. So if I am Salesforce, if I am ServiceNow, if I am any other SaaS company, I'm selling access to a tool on a per seat per month license. What is now happening is a transition, slow but surely, a transition to service as a software, where what enterprises want is an outcome, not just a seat license. Can you give me an AI agent for HR that's going to help me shift some costs around running my HR operations? So that's on an outcome basis per resolution. And what's baked into that cost is, I'm going to say, compression of the margin, because the expectation here is that when I'm getting that outcome, behind the scenes, that SaaS, that offering, that capability now has to make requests to an AI model, hopefully one of the frontier models, which means that every query that's being run, it has two costs. It has certainly the compute cost, and then it has the token cost. And then as soon as agents get involved, there is an explosion in token consumption, in some cases 10 times, maybe even 100 times, depending upon how complex the task is. Right? So the margin is now compressing. So if I'm a traditional SaaS vendor, my margins are now beginning to be squeezed. And there is some evidence that the math doesn't quite work. So as an example, the GitHub Copilot, famously, there was a study that they're losing $20 per user in early 2023. I'm sure they'll figure out some ways of getting around it. Replit, they had sub 10% gross margin at peak. Again, they lifted the pricing from 20 to 20, 30% up, and so on and so forth. So the implication here being that if the AI companies continue to have lower margins than SaaS, maybe Wall Street is going to reward them with a lower multiple. All right. So that's one of the crises. I talked about this one a little bit, but it's worthwhile revisiting this as well, which is the AI cost paradox. So what's interesting is that as we continue to build bigger and bigger models with better and better architectures on hardware that is more and more expensive, so certainly the training costs tend to go higher and higher. But the inferencing costs to run the same model is declining. Right? The adoption is accelerating. So that's yet another curve. But the expectation of cost per thousand tokens is declining. So there is something broken in this model tension, which is that building the frontier model is exponentially more expensive. But selling across the access cost, the cost of access is declining. And we'll see this in detailed graphs. So here's an example, like performance per dollar. So this is purely onto the infrastructure side. So if you look at whether it is NVIDIA chips as an example, the performance tends to get better and better, which means the cost of inferencing for the cost of inferencing for GPT 3.5, if that was $20 in 2022, that's going to cost OpenAI only 7 cents in 2024, giving you a return of 280 times. With some of the efficiencies achieved in the model, like Phi 3 with 3.8 billion parameter model can outperform historically what was Palm 540 billion parameter model, which is 142 times improvement. So what we're beginning to see is the performance per dollar of the hardware is improving. The performance, the algorithmic improvement in the model, which means that as soon as you build a model and you start then monetizing the model, you're basically now into an arms race that when the next model comes out, that's going to be cheaper to run. Your running inferencing costs are already higher, so now you're running against a you're really swimming upstream. Then finally, the other thing that's going on is that the interesting tension that was going on between open and closed source models, closed source are beginning to close parity. There was a point where on MMLU benchmark, the open source models had as much as a 8%, 10% difference. Well, now with open source models, that gap has shrunk to under 2%. So open source models are reaching parity as well. Therefore, that's yet another tension in the business model for these mega AI model, frontier model providers. And of course, who can forget the DeepSeek AI Sputnik moment? So what happened on January 27, 2025 is NVIDIA suffered the largest single day drop in the US market history, losing nearly $600 billion in their market cap. This was triggered by a Chinese AI company that most people had not heard of. I mean, had not heard of at that point. We have all since heard of DeepSeek, a Guangzhou based startup from our street. They released an open source, what they call a reasoning model, which matched OpenAI frontier models' capabilities at a fraction of the cost. Famously, Mark Andreessen called it the AI's Sputnik moment. And the comparison is really quite apt. This was like how Soviet Union shocked America in 1957. DeepSeek demonstrated that the Chinese capabilities had far exceeded the Western expectations. And then quite clearly, they had a number of innovations that they introduced, ranging from architectural architectural breakthroughs that slashed the memory requirements by as much as 93%, to successful FP8, and we'll get into some more technical details subsequently. But they trained a 670 billion parameter model, allegedly a much smaller model compared to OpenAI's frontier model at the time. And they achieved similar or better performance on a number of tasks. And by the way, not only NVIDIA lost the market cap, the contagion spread across the sector. Broadcom lost 70%, Micron lost 12%. There was certainly billionaire wealth lost both by Jensen Huang and Larry Ellison as well. So the reason why I bring this up is that in addition to those hidden costs, the frontier model providers are now facing headwinds from new entrants into the market, such as DeepSeek. And then maybe final couple of things that I want to talk about within within the promise versus reality in within certainly the enterprises on ROI. So very famously, there was a study done by MIT which claimed that 70% of the projects failed to deliver promised ROI, and they broke it down into whether it was, hidden costs, not in quotes, such as, the cost of implementation, cost of integration, certainly the big kahuna, which is the cost of bringing the right data to the model, because the model is only as good as the data. Of course, once you implement our solution, you need some ongoing tuning. That had some additional costs as well. And then, there was a reality check around time to value, because the vendors claimed that they could achieve ROI within 3 to 6 months. The actual reality was the projects had to run as long as 12 to 18 months. And what this did is it gave the enterprises a pause that the ROI success factors around APIs, vertical AI, API services, there is some churn. And it gave industries a pause around how they go about implementing their AI. So this was the first, not a not a stop, but a pause, that the enterprise adoption started to slow down when it came to adoption of AI. Perhaps one final page on these significant investments that are being made. So Arvind Krishna, who is the CEO of IBM, he went on to a podcast on The Verge to talk about how there is a gap in the math for all of the infrastructure investments that are being made. And the punchline here is as follows. Arvind's calculation is that for all of the investment that's already committed to build, which is allegedly as much as $8 trillion, it's going to require as much as $800 billion of annual profit just to pay back the interest. Let's pause for a second. The current committed build-outs from OpenAI / Target, $1.4 trillion, Meta, CapEx, $70 to $72 billion, Alphabet is only $90 odd billion and such. So the position that Arvind is taking is that if a single company is committed to spending 20 to 30 gigawatts in data center capacity alone, not taking into account a hardware refresh cycle of, say, approximately 5 months. So even if they get so advanced that they can repeat the XAI Colossus data center build out, and they build these things in span of 122 days and rack and stack those from build out to training, they can do that really, really quickly. Well, that only works if they have unlimited power, which they don't. So if these companies are committing 20 to 30 gigawatt of data centers, to fill that data center, they need as much as $80 billion for every 1 gigawatt of data center. You times that by the 100 gigawatt that's committed to spend annually, and you're looking at a impossible number. Now, keep that in mind that, this is one individual's view, but I think it's certainly a good back of a napkin math that says that, okay, there is some very bullish projections that have been made by the organizations, and potentially they'll have to look at new business cases, and hence this explains some of those circular economy loops as well. Okay, so let's take stock of everything we've discussed so far. So, we talked about how data hungry the new models are, the amount of money that's required to train these systems, the burn rate for these companies in building these massive data centers, the hidden costs that we talked about, the new tax that they have to pay, whether it's around data, whether it's around building of these data centers, nuclear power plants, the rising cost of compliance. So it might seem that all is lost. But there is an emerging buyer that changes everything about this investment thesis. And that buyer is nation states. Nation states have committed all over the world over $500 billion AI infrastructure since 2024. And these nation states, they're not playing by the Silicon Valley rules. So let's begin. So let me show you what's truly happening and what provides a floor to the significant amount of money that's already committed. So, since the start of 2024, the various nation states they've committed to invest as much as $500 billion in AI infrastructure. So, what we're seeing is a fundamental shift in who is backstopping the AI infrastructure. And this isn't a yield seeking capital, by the way, to be clear. This is a strategic capital. And there are three things that make this totally different. Number one, this investment, this is interest rate insensitive. In other words, when the Fed, as an example, raises interest rates, say, to 5.5%, the funding dries up, right? But with sovereign wealth funds, they keep deploying. That's because they're not running a direct fund model. They're running geopolitical calculus. So what's happening is that sovereignty of AI and to some extent digital sovereignty is now emerging in these geopolitical turbulent time, a key area that nation states want to own, want to invest in, and make sure that they are in control of their own destiny. Number two, nation states are no longer limited partners or LPs. They're now market makers. So think about, so they're not quite passive partners such as, say, Sequoia Capital, as an example. They're now active market makers. As an example, UAE's MGX, they are taking board seats into these large companies. Saudi's PIF is building a full stack AI company. So that gives you an idea of the second big change that's happening. Number three, the timelines right now, they're political. In other words, AI hardware demand is now operating on a political timeline, 10, 20, 30-year horizon, not just a typical 7-year funding cycle. And you might ask as to why is this is happening? Well, really, clearly, the reason why this is happening is because number one, geopolitical risk hedging with everything that's going on. Number two, I talked about the digital sovereignty, AI/cognitive sovereignty. And number three, a growing belief that sovereignty of AI and controlling the destiny of the future of AI for a nation state will also provide economic diversification, right? Especially for the Gulf states post oil. So that gives you really a floor of that strategic impact that's going on. All right. Now let's spend a little bit of time looking at the middle of this page around where is the capital coming from. Let's start with Saudi. So they announced a project called Project Transcendence, which is $100 billion initiative. That's not a typo, by the way, $100 billion initiative. They launched Humane in 2025, May of 2025, I believe, which is now controlled by PIF or the Public Investment Fund. Their commitment, 600,000 NVIDIA GPUs over a 5-year period, by the way, and a multi-gigawatt compute capacity. Imagine what that does to NVIDIA stock price. And what really are they targeting? What they're targeting is they want to capture 6% of global AI computing by 2034. And they're using their cheap energy as a economic and a competitive advantage. Let's talk about UAE. UAE is even more aggressive with MGX. Their new AI investment is targeting as much as $100 billion in assets. They took a $7 billion equity stake in US Stargate, as an example. They are building the world's largest non-US, outside of US, AI campus, 5 gigawatts in Abu Dhabi. The $40 billion AI aligned data centers acquisition in October of 2025, it was the largest data center deal ever in the history of humanity. So here's what matters. The government controlled funds, they deployed $23 billion in actual AI spending in 2025. That's 63% of all global sovereign AI investments over the past 5 years. You can even argue that the Gulf is the center of gravity when it comes to nation state investing in AI. Let's look at what's happening in Asia. China has committed as much as $900 billion over the past decade in government backed VC funding. Big Fund 3, and we'll talk about Big Fund 3 in the next episode in a lot more detail. The third element, the third portion of the Big Fund is $47 billion for semiconductor self sufficiency. They no longer want to be GPU constrained, GPU poor. South Korea, on the other hand, in December of 2025 created the what's now called as the semiconductor blueprint, 700 trillion won, which equates to, depending upon the market rates, conversion rates, somewhere between 475 billion to as much as 518 billion dollar to build 10 new fabs by 2047. This is the most aggressive per capita AI investment committed globally. Japan has committed a $65 billion AI national framework. They made Rapidus, which is the 2 nanometer chip champion. That's the state is the largest stakeholder. So that should give you an idea of the scale of investment. And not to be left behind, by the way, Europe. France has staked the clearest claim to sovereign AI. Macron announced a 109 billion euro partnership in February of 2025 at the AI Action Summit. And let me quote his exact words. AI is a fight for our sovereignty, for strategic autonomy. That those words alone give you a view into how nation states and nation state leaders are viewing AI to be so critical to the core of existence of their nations. The European Union, through Invest AI, they have committed to invest 200 billion euros over a 5-year period, including funding for AI gigafactories. They're basically trying to decouple Europe from their dependence on US AI providers. Where do you think that money is going to go? Even though with the significant amount of investments, there is only a handful of companies, whether it's, of course, NVIDIA, Google TPUs, AWS Trainium. There is a limited amount of companies that are going to be able to provide the GPU in order for even the sovereign wealth funds to build their AI capacity. So even though in the first part of our podcast, it might seem that maybe the business model is out of whack, well, this $500 billion investment and more, it really provides a capital floor. And therefore, you see, maybe if not irrational exuberance, but you certainly see the stocks for Magnificent Seven going in only one direction, up. Finally, maybe let me spend a couple of minutes on the Stargate project. So the US Stargate project, $500 billion over a 4-year period. This is yet another proof point. And by the way, have a look at the ownership structure. SoftBank has 40%, OpenAI has another 40%, Oracle has 10%, and critically MGX, as that we previously talked about from UAE, they have a 10% stake. So this is not just about American AI giants, by the way. This is sovereign capital at the table. And this is happening globally, right? Stargate UAE is already planned with 5 gigawatts. Stargate Norway, Stargate in Argentina. So this is going to be the new model. Sovereign capital with frontier AI models and hyperscaler execution. This is going to be the template of growth of AI for the next decade. Now, not to be left behind, beyond just the monetization of the AI models through tokenization and selling tokens over an API, what we're also witnessing is a $300 billion alternative AI economy, for lack of a better term. So on the previous page, we established the floor. Certainly, the nation states that have committed $500 billion plus to AI infrastructure. So think of it this way. The nation states, because of sovereignty concerns, they are backstopping hardware demand. But let's look at yet another lens. So that backstops the infrastructure demand, but the actual value that's currently being created, it's not just, yes, there is value being created in API calls, but it is not just in API calls. Let's start with open source, right? Of course, everybody thinks that open source means free, that they cannot make money. Wrong. That's not true at all. Let's examine Hugging Face, the darling, the de facto open source playground where researchers, organizations alike are submitting their models, their data sets, right? Hugging Face hit $130 million in ARR in 2024. And by the way, that's up from $70 million a year prior. So that's what, 86% growth. They've got 5 million users. They've got over 2 million models, as we saw. They're basically the GitHub of machine learning. Look at what happened to Databricks, $2.4 billion. They started as open source with Spark. Now they're a data lakehouse platform, classic open source core model. Mistral AI, the French darling, right? Mistral in France, they raised 2.8 over 7 rounds. They're currently now valued at well over 11 billion euros. ASML alone invested 1.3 billion euro. And of course, the sovereignty play for Europe meets open source AI. It's a win-win-win. In this scenario, the business model then is now changing. So the funnel looks like free community tier that attracts the assets, that provides a playground for developers to build new models, test new models, submit new code, submit papers with code, submit data sets. Developers learn free, obviously. Companies then pay for the enterprise feature. So that's the really open source at the core model. Then we get into then these companies graduate to private hosting because simply a repository for the models and the weights is not enough by itself. You then need private hosting. Of course, you then need security. You then need compliance. And of course, top tier of that is managed services and consulting, right? So that's how they're monetizing this. And by the way, when you talk about gross margins, you're probably looking at somewhere around 80 to 90%, right? So unlike pure SaaS, open source companies have the community doing the R&D for them for free. Think about it. 2.4 million models on Hugging Face. All of the papers that are being written because the community likes the credibility, the credence, the work that developers can do and point that to their body of work. So they are the ones that are doing free R&D for these open source startups. The marginal cost of the core product is near zero. What they're really monetizing is the enterprise wrapper. Think that through. I mean, even a company such as IBM with their WatsonX.ai offering, they started offering things such as federation to models that are hosted on Hugging Face, and you could bring those in seamlessly from Hugging Face to the location where the IBM product is deployed. In turn, of course, they are having to arbitrate and pay some money to Hugging Face as well. So open source AI companies, they are currently trading at 15 to x multiple. The API wrappers, to be clear, is only 8 to 10. So that basically means that the market is telling you where the value is. So that's just the open source monetization. Let's talk about the vertical AI economics as well. This is where the real unit economics is living today. So let's take a look at a couple of examples in this space. So let's talk about Hippocratic AI. This is a healthcare company. They are charging $9 per agent for healthcare tasks. They've done 115 million patient interactions. They raised $40 million total. Just looking at my notes here, they're currently valued at $3.5 billion with a B. What they're doing is they are solving the nursing shortage. They're not competing with ChatGPT, to be clear, by the way. On the legal domain, Harvey AI, they just hit $150 million ARR. In August, they crossed 100 million, 3 years after founding. They're serving 42% of the AM law firms, currently valued at $8 billion. And what does their pricing look like? $1,200 per lawyer per month at base. Enterprise, of course, goes higher. Again, the point that I'm trying to make here is that new economic models are emerging. In the case of these vertical AI economics, you're looking at 10x better than LTV. Why? Because domain expertise means faster deployment, right? You no longer have to be dependent upon user interviews, discovery workshops. Let's understand what the use case is going to look like, etc. There is a whole lot less customization that's required. There is high willingness to pay, 60% lower cost for implementation because AI already knows the domain. And then finally, I'm going to call out the data network effects. So that's the real compounding play. So let's take a couple of examples of Perplexity and Scale AI. So Scale AI did $870 million alone in 2024, projecting $2 billion in 25. Meta paid $14.3 billion for 49% of the company. And why is that? That's because Scale AI has RLHF, reinforcement learning, feedback foundation that makes the foundation models better. Every major AI lab in the world, OpenAI, Google, Anthropic, they have used Scale's data. That creates a flywheel, right? Better data, which means better models, which means more customers, which means more data. And Scale AI is at the heart of it. Perplexity, on the other hand, they raised $100 million ARR with their search product, right? 22 million active users, 780 million queries in May of 2025. What are they doing? They're building a data moat on what people actually search for, a different flywheel altogether. So, proprietary data, right? Better models, more customers, more data, and then the cycle continues. Each crank, each turn at the flywheel makes the next turn easier and more valuable. Okay. So we talked about where the money is coming from, what the revenue looks like for these major AI providers, the costs, how they're projecting to spend money on data centers, some of the hidden costs and tax. We talked about the 500 billion plus backstop because of sovereign AI projects, the emerging alternative models and such. What else is happening? There's one other thing that we haven't quite talked about, and that is going to be evident from this picture here. So, what this picture is telling you is all of the models that have been released in billions of parameters, and I know it's a selection of models, not every single model that there is, but there is an interesting effect that one can observe, which is that the exponential growth of LLMs, of multi 100 billion parameters, seems to have, if not stopped, slowed down a little bit. And what do you think is going on there? Well, what's happening there is the rise of small language models, right? So what's happening is, or at least on the enterprise side, the what's old is new once again. So organizations have figured out they don't necessarily need the biggest, baddest model that there is on the planet to solve every single problem that they have. Perhaps they can create a small enough language model that they can fine tune or customize for their enterprise needs. Ergo, the rise of small language models. Now, to be clear, the industry does not have a definition of what exactly is small. A small could be as little as less than 1 million parameter models. But generally speaking, somewhere between 7 to 13 billion parameter models seems to be the sweet spot of cost, of performance, and the ability to monitor these models. And all three have to be true. Examples being such as the Mistral 7B, Llama 2 7 billion parameter model, the Granite series of models, Granite 3 and 4 from IBM, somewhere around 7 to 8 billion tokens. They're highly competitive on specific tasks. So the idea is that these small-ish models, they have general purpose reasoning. They have some emerging capabilities such as reasoning capabilities, logic capabilities, tool calling capabilities. The training costs of these models is lower, less energy, fewer resources. They're able to inference faster just by the virtue of being a smaller model. They don't quite need the big hunking infrastructure, so they can be deployed on mobile, on edge devices, IoT devices. They can be very easily fine-tuned for domain-specific tasks. By the way, there is a wide plethora of these models available in open source community with open weights as well. The benefits of these small language models are, of course, efficiency and speed because they're highly efficient. The footprint is pretty small. As I said, they can be specialized and or fine-tuned for downstream tasks, cheaper, much more accessible, and they provide freedom of action on where these things can be deployed anywhere in the world. So I think that's the next evolution that we're going to see of AI models emerging, at least in the enterprise space. So let's wrap up. Let's take a step back and look at what follow the money means in the context of state of AI today. What you're going to begin to see over the course of next few years is the AI hyperscalers having to take part and having to take into consideration water rights tribunals, not just chip fabs. You'll see a lot more data licensing deals emerge, not just around training runs. Margin compression is going to continue to happen, not just revenue growth, which is why you're going to see these circular funding loops and alternative business models that are going to continue to emerge. The AI hyperscalers are going to continue to build newer ways of vertical AI moats beyond just foundation models. You're going to see a lot new architectures and algorithmic improvements around efficiency gains, not just parameter counts. And then finally, we're going to have to battle with unit economics and not just total addressable market projections. All right, just before I let you go, in the next topic, in the next episode, we are going to talk about China and in particular, China, China responding to constraints. And let me just give you a little teaser. The answer involves technological innovations that shook the industry. The next episode, we are going to cover the Sputnik moment from DeepSeek. We're going to into it a lot more detail than we did in this episode. We're going to talk about the Big Fund 3 and then the physical economy bet. I hope you found this episode informative and interesting, and I look forward to seeing you on the next one. Thank you.